Welcome to the deep dive. If you're like most people, you probably have maybe three, maybe more products from the Clorox Company, ticker CLX, somewhere in your home right now. We're talking bleach, wipes, trash bags, maybe even Kingsford charcoal out by the grill. So today we're putting this classic American household name, well, under the microscope. Our mission here is to really unpack a comprehensive, fundamental analysis. We want to look past the familiar blue bottles and the charcoal bags. We're asking, I think, a really critical question. Can the enduring strength, the decades-long power of these iconic market-leading brands, can it actually withstand these massive, almost self-inflicted operational setbacks? And, maybe more importantly, this looming financial distortion that looks like it's about to throw the whole income statement into, well, chaos.
It's a fascinating setup, isn't it? Especially for what you'd normally think of as a steady, mature consumer goods company. If you're analyzing Clorox right now, you're looking at a business caught in a pretty severe cycle of volatility. We're navigating this critical period between fiscal 23 and 25. It's defined by brand resilience, and that's definitely strong, but it's being tested by some severe internal corporate challenges.
Yeah, okay.
Most notably, there's this necessary but highly disruptive enterprise resource planning system transition, the ERP rollout. And that's leading directly to a predicted, highly quantified, and basically unavoidable earnings cliff that's scheduled for fiscal year 2026.
Right. Okay. So before we get into that turbulence, let's just establish the baseline. Clorox, they're a leading manufacturer of consumer and professional products, and their strength, it really lies in that portfolio dominance, doesn't it?
Absolutely.
We're talking about true category leaders. Clorox itself, Glad, Pine Sol, Liquid Plumber, even things like Burt's Bees and Natural Personal Care. The critical fact, I think, the real foundation of any investment case here, is that the vast majority of these brands hold a number one or number two market share position in their categories. They aren't just competing, they pretty much define the market space.
Okay, so let's start where we always do, the competitive advantage. For a company like Clorox, the advantage isn't really the chemicals in the bottle, is it? It's the trust. It's that logo. The product might be the wipe, but the real asset is the label that says Clorox.
Precisely. And it's crucial to understand that the primary competitive moat here, it's not about, say, marginal manufacturing efficiency or some huge logistical scale, though those things definitely matter.
Sure.
It is the portfolio of iconic, trusted brands. Just think about why someone pays, maybe $5 for a branded item when the private label version right next to it is $3.
Right. They're paying for perceived reliability, consistent quality, and maybe most importantly, in the cleaning space, they're paying for the belief in effective results. That's what the brand signals. And this brand equity, it allows Clorox to do two really critical things.
Yeah.
First, obviously command premium pricing relative to the generic or store brands. And second, and this is a factor people often overlook, it helps them secure preferential, really powerful shelf space with their major retail partners.
Oh, okay.
Retailers know consumers will actually look for the Clorox name, and that power translates directly into negotiating leverage. It helps them get that eye-level placement, the end cap displays that, frankly, smaller brands just can't access.
And when you really think about the breadth of that portfolio, it just underscores how much market saturation they command, doesn't it? We're talking Clorox bleach and wipes, Pine Sol cleaners, Liquid Plumber for drains, the huge Glad trash bag business, Kingsford charcoal dominating grilling season, Fresh Step kitty litter, Brita water filters, and then that premium Burt's Bees line. That's a roster that's deeply embedded across the entire household, from the laundry room to the kitchen sink to the bathroom.
It is a powerful roster, no doubt about it.
Okay.
But here's where it gets really interesting right now. That loyalty, that perceived premium value, is being rigorously tested. We've spent the last few years navigating this high inflation environment, coupled with just general economic uncertainty. Consumers are, they're making harder choices at the shelf.
And the sources we looked at show that management, they acknowledge this shift, right? They've specifically noted rapidly shifting consumer behaviors. So what does that shift actually look like when it hits the financial statements?
Well, it translates directly into pricing pressure. To maintain volume, defend that market share against the cheaper private labels, Clorox has had to increase what they call trade promotion spending, which is really just a sophisticated way of saying they're increasing promotional activity. More buy one, get one frees, more coupons, deeper discounts, basically trying to drive purchases when consumers are feeling squeezed. And, when a company starts leaning really heavily on promotions like that, it's usually a clear signal that their organic pricing power, the ability to just raise prices, is diminishing. The brand moat is still strong, it's still there, but the water level's rising high against it, right? It's forcing them to spend money, that promotional cost, just to hold on to their volume. They're effectively trading margin for volume. It's a classic defensive move in a tightening economy.
That makes perfect sense. They protect the shelf space, protect the absolute volume numbers, but it comes at the cost of profitability per unit sold. Okay, now let's pivot a bit to the structural composition of the business itself, because this introduces what looks like a significant structural vulnerability, their geographic concentration.
Yeah, that's a big one. Clorox segments its revenue into four main categories: health and wellness, household, lifestyle, and international. In their fiscal year 2025, health and wellness was the clear leader, about $2.7 billion, and it showed a decent 8.5% increase year over year.
Okay.
Household was solid at $2 billion, lifestyle at $1.3 billion, but international, that was the smallest at just $1.07 billion, and crucially, it was the only segment that actually saw a year-over-year decline in revenue.
Wow. Okay. So $1.07 billion out of a total revenue base. That's over $7 billion. That means the international business is, well, it's a pretty small fraction of the total pie.
Exactly. And this points directly to the massive U.S. concentration risk. Clorox operates with this overwhelming 8,515 domestic to international revenue split. If you look at the FY 2025 numbers, total U.S. revenue was $6.08 billion versus only $1.02 billion from all foreign markets combined. This is a really crucial distinction when you start comparing them to their peers.
Yeah, I think this is a point you, the listener, need to really grasp. If we look at the giants in this space, like Procter & Gamble or Unilever, they're truly globally balanced, right? Often 40%, 50%, even 60% of their revenue comes from outside the U.S., particularly from potentially higher growth emerging economies.
And that diversification, it acts as a natural stabilizer, doesn't it? If the U.S. consumer suddenly pulls back on spending because of, say, recession fears, a company like P&G can potentially offset some of that weakness with maybe robust growth in India or China or Latin America. Clorox simply doesn't have that lever to pull.
Right.
Its heavy reliance on just one single mature market, the U.S., it amplifies the impact of every single U.S.-specific trend, every little shift in consumer habits, every major weather event impacting charcoal sales, and most critically, every inventory decision made by those big U.S. retailers. It just hits Clorox harder than its more global peers. It makes it inherently a less diversified and therefore, you could argue, a potentially higher risk investment from a purely geographic standpoint.
Okay, so since the U.S. market is basically Clorox's entire world, we need to really understand that world. They operate in the global household care market, which, I mean, it's huge, valued at about $110 billion in 2024. But size isn't the same thing as growth, is it?
No, far from it. This is a really mature sector. The projections show it growing pretty modestly, maybe 3.7% compound annual growth rate through 2034. And when a market grows that slowly, competition essentially becomes a zero-sum game.
Right.
You can't just rely on the overall market expansion to lift your revenue boat. Growth has to be aggressively fought for, basically stolen from a rival's market share.
Which means the pressure for innovation becomes almost exhausting. It's not necessarily innovation aimed at explosive new growth. It's more like the innovation treadmill. You're running constantly just to maintain your existing market position and, crucially, justify that premium pricing we talked about.
Exactly. And we see this kind of defensive imperative reflected in their recent activity. For instance, they relaunched the Poet fragrance platform that's designed to try and recapture some share in the household scent category. Or look at the enhancements they've made to their Glad trash bags, like the Glad Force Flex Max Strength line. These aren't necessarily, revolutionary breakthroughs. They're more like defensive moves, designed to ensure the consumer continues to see value in paying a bit more for the Glad or Clorox brand over a cheaper store brand alternative.
That recent launch of the Fresh Step health monitoring clumping litter seems like a good example of trying to differentiate, too. It's an attempt to add like a high-tech utility feature to what's otherwise a pretty standard product, moving it away from being just a commodity towards something more like a value-added service.
Precisely. They're constantly seeking that incremental advantage.
Yeah.
But even with all these efforts, they face this almost insurmountable challenge, a structural scale disadvantage.
Let's put some numbers to that gap, because it really is staggering. Clorox has a market capitalization currently around, what, $15.3 billion?
Roughly, yeah.
We mentioned their largest rival, Procter & Gamble. P&G boasts a market cap of around $365 billion.
Yeah.
P&G is literally 20 times larger than Clorox.
And this scale disadvantage, you could argue, is probably the single biggest long-term constraint Clorox faces. P&G's absolutely vast revenue base gives them significantly superior leverage across the board with suppliers, with transportation companies, and crucially, with those powerful retail partners we were just discussing.
So how does that 20-fold difference actually impact the day-to-day business, the stuff the consumer doesn't necessarily see?
Well, it hits their cost structure hard, and it hits their marketing war chest even harder. P&G can simply afford to spend exponentially more in absolute dollar terms on R&D and advertising. Clorox might have a really excellent innovation team, but they cannot possibly match P&G's budget for digital marketing, targeted ads, or even long-term basic science research. P&G can also achieve far better economies of scale in things like logistics. I mean, when you're shipping 20 times the volume, your per-unit freight costs just plummet. So Clorox has to be fundamentally nimbler, more efficient with every single dollar they spend just to try and remain competitive, just to keep pace with that behemoth. They have almost zero margin for error when it comes to execution.
Which makes their own internal operational issues, like that cyber attack recently, or this ERP transition we're going to talk more about, even more costly, right? Because they can't just absorb those kinds of hits the way a giant like P&G might be able to.
That's precisely right. It magnifies the impact of any stumble. Now, let's circle back to the U.S. market and talk more about that critical distribution dynamic specifically, the customer concentration risk.
Right. Clorox is highly reliant on a pretty small pool of incredibly powerful retail partners. We're talking Walmart, Kroger, Costco, the big mass merchandisers and grocery chains. If one of those giants sneezes, Clorox catches a pretty serious financial cold.
And the source material gives us a really vivid illustration of the immense leverage these retailers have. It really showcases the double-edged sword of retailer power. On the negative side, we saw a clear example recently of destocking.
Okay, what's destocking?
That's basically when retailers intentionally choose to reduce the amount of inventory they keep on hand, maybe to free up working capital or warehouse space. And that retailer destocking decision caused an immediate 11% sales drop in Clorox's household segment in one recent period. This particularly hammered their bulky items. Think about a warehouse club deciding they don't want 50 pallets of Cusford charcoal or those massive rolls of Glad trash bags taking up valuable floor space right now. That decision, made entirely by the retailer for their own capital management reasons, immediately wipes 11% off a Clorox segment sales, completely independent of whether you, the American consumer, still want to buy that charcoal or those trash bags.
Wow. That's a really stark demonstration of how inventory control decisions, just made at the retailer level, can instantly overshadow whatever the real-time consumer demand might actually be.
And then here's the flip side, the kind of artificially distorted positive example, which directly sets up the main crisis point of this whole deep dive, the inventory pull forward. This happened right ahead of the big fiscal year 2025 ERP system implementation. Now, this wasn't driven by increased consumer demand at all.
Right.
It was retailers strategically building up massive inventory reserves, specifically to hedge against any anticipated supply disruptions Clorox might face during that complex ERP system switchover.
So the retailers use their leverage not just to cut inventory sometimes, but in this case, to temporarily increase it massively, purely for their own risk management.
Correct. And this artificially boosted Clorox's reported results in FY 2025.
Yeah.
It perfectly illustrates the structural, just immense leverage that these few retail partners hold over Clorox's financial statements. They can effectively manipulate the timing of when sales get reported.
Okay, let's transition now from those operational challenges to the resulting financial health, because the last 5 years, looking at their income statement, it's been a story of really dramatic volatility. We've seen these massive profit swings, right? From the highs during the pandemic peak demand down to the lows when inflation was just rampaging.
It's truly been a roller coaster when you look at profitability. If we trace their gross margin, GM, you can really see the impact of those external factors. GM peaked at a very strong 45.6% back in fiscal 2020. That was when pandemic demand meant they could basically sell everything they could possibly make, and at pretty high prices too. Then global inflation hitting resin for plastic products, hitting logistics costs, manufacturing inputs, just slammed that profitability. It drove the GM all the way down to a low of 35.8% by fiscal 2022.
Wow, a drop of nearly 10 full percentage points. That's devastating for a consumer staples company, isn't it? They were essentially giving back maybe a decade's worth of operational gains in just 2 years, purely due to that external inflationary pressure.
It was a major hit. But you have to give credit where it's due. The management team recognized the crisis and focused very heavily on recovery. They implemented what they termed holistic margin management. This involves some aggressive pricing actions where they could, supply chain optimization, and significant internal cost-saving initiatives.
And their execution on that front looks pretty strong. We saw gross margin recover significantly up to 43.0% in FY 2024, and then it expanded even further to 45.2% in FY 2025. That recovery, that's a measurable operational achievement, right? It demonstrates their ability to fix internal inefficiencies when they focus on it.
It is. It's a phenomenal recovery on paper. But, and this is the critical analytical caveat that you, the listener, really must grasp, that 45.2% margin achieved in fiscal 2025 is not what we call clean. It's actually artificially inflated.
Ah, okay. This relates directly back to that retailer inventory pull forward we were just talking about. How did the timing of those extra shipments affect their gross margin number?
Well, management was actually quite transparent about this. They stated that the incremental, likely high-efficiency shipments associated with that ERP transition pull forward contributed approximately 50 basis points, or half a percentage point, to that full-year GM result. And here's the crucial part for forecasting. This 50 basis point one-time benefit is explicitly expected to reverse in fiscal year 2026.
Okay, so let me make sure I understand this. If the reported improvement in gross margin was 220 basis points, going from 43.0% up to 45.2%, the true sustainable underlying improvement from their core operational cost savings and pricing action was actually closer to 170 basis points. That 50 basis point difference, while it might seem small, represents potentially hundreds of millions of dollars in profit difference when you're forecasting long term. And it clearly shows the non-recurring nature of part of that strong 2025 performance.
Exactly right. You cannot confidently just project a 45.2% GM forward into the future. You have to mentally adjust that number down before you start analyzing their future profitability potential. Now, let's move from the income statement volatility to some broader structural issues, particularly on the balance sheet. Leverage.
Yeah, looking at their financials at the end of fiscal 2025, the picture seems pretty clear. This looks like a company with a highly leveraged capital structure. Total debt stands at what, $2.88 billion? Against a very, very thin total equity base of only $482 million.
That math produces a debt-to-equity ratio of approximately 6.0x, which is high. I mean, for a mature, generally stable cash flow business like consumer staples, investors often accept higher leverage than they would for, say, a cyclical manufacturing firm. But 6.0x is definitely at the higher end of the range, certainly relative to peers like P&G or Kimberly-Clark, who often manage the ratios closer to maybe 3x or 4x.
I have to press you on this a bit. What are the concrete consequences of carrying 6.0 times debt to equity, especially as they head into a year, FY 2026, where we know earnings are going to be weak?
Sure. There are really three main consequences. First, obviously, there's an increased interest expense burden, which directly cuts into their net income. Second, there's rating risk. High leverage like this puts pressure on their credit rating, which in turn increases the cost of any future borrowing they might need to do.
Okay.
But the third consequence, and arguably the most strategically important one, is the constraint it puts on their financial flexibility. That high debt load severely limits their capacity for any large, transformative mergers or acquisitions. M&A is often the fastest way for large consumer companies to enter new, faster-growing markets or diversify their product lines away from mature categories. With 6.0x leverage, that large-scale M&A option is essentially off the table for Clorox right now.
So they're strategically boxed in, basically?
Pretty much. It forces them to do what we call a self-help story. They have to rely entirely on organic growth from their existing brands, internal innovation hitting the mark, and just maximizing efficiency from the assets they already have.
But if their organic growth targets, as you mentioned, have consistently underperformed that 2-4% goal, isn't being purely a self-help story kind of just another term for potential stagnation, especially in such a mature, competitive market?
That is absolutely the core risk for investors, yes. However, there is one mitigating factor here, which is their cash generation capability. Despite the high leverage, the underlying business is robustly cash generative. Their operating cash flow, CFO, was $981 million in FY 2025. And importantly, CFO has consistently been higher than their reported net income across recent years. That's usually a key indicator of high-quality earnings, meaning the profits they report are generally being backed up by actual cash coming through the door. This cash flow provides a degree of stability, even if the leverage significantly limits their strategic upside.
Okay, so that cash generation provides a bit of a buffer, but it brings us right back to the central turbulence we keep mentioning. This crisis cycle that ran from roughly 2023 to 2025, it really looks like it's been an operational double whammy for the management team to navigate.
It really has. It started with the external shock, that cyber attack back in August 2023. This was a critical security breach and caused significant operational disruption, messing up order processing, causing shipment issues, and it materially impacted their results throughout the first half of fiscal 2024. Now, fortunately, they did get systems fully restored, but it definitely caused them time, money, and crucially, momentum.
And then the second event, which seems far more damaging in terms of the forward-looking financials, is the internal disruption. This multi-year transition to the new Global Enterprise Resource Planning, or ERP, system. Why is what sounds like a necessary IT upgrade causing such immense financial distortion down the line?
Well, it goes back to triggering that retailer leverage we discussed earlier. These ERP implementations, they're incredibly complex enterprise-wide technology transitions. The risk of supply chain disruption during the switchover, missing orders, shipping delays, system crashes, it's perceived as being quite high. And the retailers, exercising their immense power, reacted, frankly, quite logically. Anticipating potential trouble during the main FY 2026 implementation phase, those big retailers strategically demanded, or at least accepted, unusually high levels of preemptive inventory. They essentially built up massive stockpiles in their own warehouses during the fourth quarter of fiscal 2025. Why? To shield themselves from any potential Clorox system failure. That strategic move made by the retailers for their benefit is the direct source of the artificial financial boost Clorox saw in 25.
Okay, right. So let's quantify this distortion, because this is where that concept of the earnings cliff becomes a concrete reality, not just some abstract forecast. The FY 2025 numbers were, as you said, an artificial high. How high?
The distortion was significant. Management actually provided quite specific figures on this. That inventory pull forward added a full 3.5 to 4 percentage points to Clorox's net sales growth for the entire fiscal year 2025. That's a massive, clearly one-time boost to their top-line revenue number.
Okay, 3.5 to 4 points on sales. And what was the bottom line impact? How much did it actually inflate their reported profit for that year?
It contributed somewhere between 85 and 95 cents to their reported diluted earnings per share. So for you, the listener, if you looked at Clorox reporting seemingly strong earnings for 2025, you have to understand that roughly $1 of that reported profit was essentially borrowed from the future. It means FY 2025's underlying performance was structurally weaker than it appeared, masked entirely by this beneficial timing anomaly.
And that leads directly, inevitably, to the mirror image, the FY 2026 earnings cliff. The sales that got booked in late FY 2025 are sales that simply won't happen in FY 2026. Why? Because retailers will spend the first half of that year selling through those huge stockpiles they built up. This isn't forecasting uncertainty, it's basically a known accounting reversal waiting to happen.
That's exactly why management's guidance for FY 2026 is so precise and frankly so severe. They expect this reversal, this timing shift, to create a staggering 7 to 8 percentage point drag on year-over-year sales growth in FY 2026.
Sure.
And this huge drag on revenue translates directly into the bottom line, into profit.
Okay, and what is this specific EPS reduction they are forecasting because of this?
Management is guiding for, well, a brutal 22% to 25% year-over-year reduction in adjusted earnings per share for fiscal 2026. This really confirms the severity of the cliff. It means the company is going to report exceptionally weak-looking results in 2026. But the critical analysis has to show that this weakness is primarily due to the timing reversal of sales and the associated margin recognition, rather than signaling some catastrophic collapse in underlying consumer demand for their products. It's just going to be a very messy year financially, designed almost entirely by internal system choices and the power dynamics with their retail partners.
But even while they're navigating this sort of internal mess, they still have to face those structural external headwinds that aren't just going to disappear, right?
Absolutely not. They are still fighting persistent inflation in key commodity costs and logistics costs globally. And, maybe more structurally damaging, they had that persistent annualized negative impact of roughly $100 million just from tariffs on goods imported, likely from China. That $100 million tariff cost is a huge drag that hits their cost of goods sold every single year, year after year.
So how is management dealing with that massive $100 million headwind? Are they just passing that cost straight onto the consumer through higher prices?
Well, interestingly, they're trying to absorb it, at least partially, through what they call recalibrated promotions. Which brings us full circle back to our discussion about pricing power back in segment 1. Instead of simply increasing the list price of, say, their cleaning products by the amount needed to fully cover that $100 million annual tariff hit, they seem to be choosing to absorb some of that cost by increasing discounts and promotional deals offered to consumers.
Which means, essentially, they're prioritizing holding onto volume rather than fully protecting their margins. They're effectively subsidizing part of that tariff impact themselves to avoid losing market share, presumably to cheaper private label options.
Precisely. It demonstrates a clear constraint on their ability to just push prices up. They likely know that if they tried to pass the full $100 million tariff impact directly onto the consumer via straightforward price hikes, they'd probably lose too many price-sensitive customers, which would shrink their volume even further. So they're kind of stuck between a rock and a hard place here, sacrificing some short-term margin health in order to defend their long-term volume base and shelf presence.
Okay, so if we step back and try to assess leadership through this whole operational crisis cycle, from handling the cyber attack fallout, managing the ERP implementation challenges, and dealing with this tariff absorption, how would you rate their overall performance?
It really looks like a mixed scorecard. On the commendable side, their operational execution and recovering margins through those cost savings initiatives, and also swiftly restoring systems after the cyber attack, that looked pretty strong. They showed real competence in internal repair and efficiency drives. But maybe more strategically, their foresight regarding the external environment seems a bit more challenged. They appeared perhaps a little slow to react to the sheer speed of the post-pandemic demand normalization, how quickly things snapped back, and also maybe underestimated the aggressiveness of the retailer destocking that followed that demand shift. So you could say they were pretty proactive on managing internal costs, but maybe a bit more reactive when it came to anticipating those shifts in consumer demand and retailer behavior.
All right, let's look ahead now at the plan for the future, assuming they successfully navigate their way out of this 2026 earnings cliff situation. The company's long-term integrated strategy, which they call Ignite, was unveiled way back in 2019, and it focuses on things like fueling growth, driving superior innovation, evolving the portfolio, and being more agile. But, ambition doesn't always equal reality, does it?
No, it doesn't. The strategic framework itself sounds perfectly reasonable, but they seem to be consistently falling short, particularly on the top-line growth numbers. Yeah. The long-term annual goal that was set by the Ignite strategy is to achieve 2% to 4% net sales growth each year.
Okay, 2 to 4%. But if we look at the actual reality of the last few years, that gap between the goal and the results looks pretty persistent. Fiscal 2025 was essentially flat, right? At 0.16% growth. But that came after a painful 4.0% decline in fiscal 2024 and a 3.2% decline back in fiscal 2022.
Yeah, this multi-year trend of basically flat or even negative growth, it does raise some fundamental questions about the realism of that 2% to 4% growth target, especially for companies so heavily focused on the mature U.S. market. And remember, we established that they're kind of locked into that self-help strategy because of their high leverage.
Right.
If they realistically can't afford to buy significant growth through M&A, and their organic growth engine is persistently underperforming its own targets, then you have to wonder if the strategy itself is maybe structurally under-aimed, or perhaps just simply unrealistic for a company of Clorox's scale operating in this particular sector against giants like P&G.
Let's talk about what they actually do with the cash they manage to generate. For a mature consumer staples firm like Clorox, their capital allocation decisions seem overwhelmingly dominated by one single factor, the dividend.
Oh, absolutely. For CLX, the dividend is really the cornerstone of the investment thesis for many shareholders. It has this multi-decade history of consistently increasing the payment, which makes it very attractive to income-focused investors. And currently, it yields about 4.1%. Maintaining that tradition, continuing that payout, that's almost certainly their non-negotiable core financial priority.
But that cash flow needed to pay the dividend has been pretty volatile itself, hasn't it? Reflecting all those operational swings we talked about. Free cash flow, FCF, was strong at $930 million in FY 2023, but then it crashed down to $483 million in FY 2024. That probably reflects the cyber attack disruption costs, and then it recovered somewhat to $761 million in FY 2025.
Yes, that volatility is clear. And given the very high leverage, remember that 6.0x debt-to-equity ratio and also the expected weaker operating cash flow coming into fiscal 2026 because of that earnings cliff we've detailed. Well, management will unequivocally prioritize maintaining that dividend payment above almost everything else.
So things like aggressive debt reduction or maybe large-scale share repurchases, those are likely off the table for a while.
They'll almost certainly take a backseat in the near term. Management's primary financial mandate for the next year or so is going to be dividend defense. Ensuring they can continue to pay that dividend, likely even grow it slightly if possible, will be paramount.
Okay, finally, let's try to wrap this entire deep dive up by looking at how the market is currently pricing all this volatility and, more importantly, that known earnings cliff ahead. This feels like the valuation trap part of the story. This is the moment where we need to connect all the threads we've discussed.
Right. If we just do a simple benchmark of Clorox against its immediate peers, say P&G trading at a price-to-earnings PE ratio of about 23.5x with a 2.5% dividend yield, and maybe Kimberly-Clark at a PE of 17.5x with a 4.0% yield. Well, Clorox's trailing PE ratio looks kind of reasonable, doesn't it? It's sitting around 18.3x. On the surface, that looks cheaper than P&G and pretty comparable to Kimberly-Clark.
But, and this is the real aha moment for you, the learner, the part that requires that critical thinking step, that 18.3x trailing PE ratio is based entirely on the artificially inflated earnings of fiscal 2025. Those earnings that included that significant 85 to 95 cent pull-forward boost we quantified earlier.
Exactly. You simply cannot use that trailing PE ratio as a reliable gauge of current value. We have to look forward. We know, based on the company's own guidance, that their EPS is expected to decline, but somewhere between 22% and 25% in fiscal 2026, purely due to that timing reversal.
Let's just take the midpoint for simplicity's sake, a 23.5% decline in EPS next year.
Okay, so if we adjust the current stock price using that known lower earnings figure for the coming year, what happens to the valuation multiple? The true implied forward PE ratio must jump dramatically higher, right?
It rockets up. It goes to approximately 23.5x.
Wait, hang on. 23.5x. So that puts Clorox, a company facing a year of significant negative earnings growth, operating with major scale disadvantages against its main competitor, carrying high leverage at the exact same forward multiple as the massive, globally diversified, high-margin, consistently high-growth Procter & Gamble.
That is precisely the valuation trap. That implied forward multiple of 23.5x is absolutely not inexpensive for a business facing this magnitude of near-term earnings volatility and negative growth. It strongly suggests that the market, or at least the headline valuation numbers, may not have yet fully digested the severity and, crucially, the inevitability of this impending earnings cliff. Investors who might be buying based purely on that trailing PE are essentially buying based on a temporary fiction, based on earnings that were artificially pulled forward. #outshag_outro. So to kind of summarize what we've unpacked today, Clorox is fundamentally anchored by a portfolio of high-quality trusted brands, and the business has demonstrated some commendable operational recovery. Recently, they successfully fixed their margins after the inflationary hit, and they restored systems effectively post-cyber attack. That shows operational competence.
However, the short-term strategic outlook is just inherently complicated and quite messy, primarily due to that unavoidable ERP-related earnings reversal coming in fiscal 2026. It's really a story of internal operational success being significantly overshadowed by internal financial timing distortions.
Right. So looking beyond that, Cliff, the recovery story seems to hinge entirely on organic execution, doesn't it? It's about successfully translating that innovation pipeline. You know, things like the new Glad bags or that Fresh Step monitoring litter we mentioned into real, sustained volume growth and using that innovation to justify holding on to their premium pricing. And continued defense of those recovered margins through ongoing cost control is also going to be paramount. International expansion. Well, it remains a necessary but seemingly currently underdeveloped potential long-term growth lever for them.
Yeah, and what really defines Clorox against its giant peers is its focused intensity, maybe even its vulnerability to its high leverage, combined with that overwhelming U.S.-centric focus, makes it a much less diversified investment proposition. When you invest in CLX, you're not really betting on broad global emerging market expansion like you might be with P&G. You are betting very heavily, almost entirely, on the continued health and spending power of the American consumer and on this particular management team's ability to flawlessly execute those internal self-help initiatives, innovation, cost control with almost zero room for error, because large-scale M&A just isn't really an option for them right now.
Okay, so our entire deep dive today really centered on these operational crises and especially that ERP-driven earnings cliff expected in fiscal 2026. That's all relatively short-term volatility. But given the company's necessary reliance on cost control and innovation for any kind of sustainable long-term growth, let's leave you, the listener, with this provocative thought that tries to tie back to their deeper structural reality. If Clorox does successfully navigate this near-term chaos, gets past the cliff, and manages to return to some form of positive revenue growth, what specific long-term risk do you think will ultimately prove to be the tougher hurdle for management to overcome sustainably over, say, the next 5 years? Will it be the persistent structural $100 billion annual tariff impact dragging on their costs? Or will it be that fundamental structural 20 times scale disadvantage they face every single day against Procter & Gamble? Think about the implications of having to continuously fight both of those significant headwinds simultaneously as you close your notebooks on Clorox today.